The following segment is sponsored by Daniel A. White and Associates and does not necessarily reflect the views of this station or Forever Media Incorporated. Rick Jensen on 1150 AM, 1017 FM, WDEL.
Well, it should. No, I've been a client of Dan's for a few years now. He's a straight shooter, always trust the man. And on Wednesdays, afternoons at 1:30, after the news at 1:30, said mumbling, calls in with some great advice and some tips as well. Dan, thanks for being on.
Thanks for having me, Rick.
So, as I was lamenting earlier today, as many of us are who have rollover IRAs from other 401ks and things like that, some of us go into mutual funds, some buy individual stocks. I've done both, but right now it's all individual stocks and companies. We see inflation is not transitory. It's raising its ugly head for a long period of time now. We don't know how bad, how far it's going to get. Looking at 6% easily. And so there are a lot of people like myself, Dan, who are wondering, okay, what do we do? If inflation is like 5-6% and we're earning 3%, well, we're losing money. If you're earning 3% in a tax-deferred basis, well, then you could be actually keeping up with inflation based upon the tax rate when you retire. And that leads me to wondering, what a lot of people are wondering is, all right, what do we do now? You look at a company, for example, like NVIDIA, which it's one of the main stocks that I hold. I bought when they were $8. Don't want to get rid of them. I love what they do. They expand their model and they expand their business operations. And yet there are some analysts out there, professionals, saying it's way overpriced. It's overpriced by about $100 a share. I'm going, okay, great. Others saying, oh, no, it ought to go up about $45 a share. I'm thinking, well, okay, that's kind of nice, too. And they're all, well-learned, professional stock market analysts. And there's folks like me looking at this going like, I don't know, what do you do? I mean, Visa has had really no growth in the last year. The dividends, about 2%, I think, as I recall. So as we're looking at more inflation, we know the stock market is got to have a reset. We just don't know how far. Is it going to be like 2008, 40, 45, 50%? Is it going to be like 20%, 10? So this is something that you think about and you work with every day, Dan. What do you say?
Yeah, people are really in a quandary right now, Rick, because the Fed has really painted themselves in a corner. Usually, if you think stocks are overpriced, you go to bonds as the safe haven. But bonds have been in a bull market for 40 years, and let's face it, interest rates really can't go any lower than they are now. And the Fed has already said in 2022 we're going to raise rates 3 times. Well, when they raise rates, what happens? Yields go up, but bond prices go down. So you're looking at negative returns in the real marketplace. If you're getting 1% at the bank and inflation 6%, yeah, you're underwater. Bonds aren't looking like a safe alternative. Stocks aren't looking like a safe alternative. I mean, sometimes cash is king, and even though you're losing money in cash, at least it's you know where it's at, and maybe you can take advantage of some opportunities down the road. I actually did a blog recently, which really was kind of amazing. It said, from 1990 over the last 30 years, the markets have created an unprecedented $75.7 trillion in new wealth. The world's never experienced anything like that. But in the $76 trillion in new wealth was generated by 2.4% of all stocks.
Wow, and are those tech stocks?
Yeah, they are. I mean, you look at the top 20. It says 55.2% of all stocks traded on the major exchanges over the last 30 years delivered returns less than a 1-month Treasury bill rate, which is currently 0.03%.
Man. Now I know
picking stocks is kind of difficult.
Now I know, right? I'm just trying to pick good companies, and I've made more good decisions than bad decisions. I've had my losses. I've been on some real dogs out there, but I listen to a lot of people. I read, study, and I try to make good decisions. You're one of my key advisors, as you know. Yeah. So it's just look at this thing and okay, so I just take our profits right now and just made money last year. Last year was great for, my retirement accounts and the IRAs often do much better than the professionals who manage mutual funds. That's that sort of thing, depending upon the fund. So it's interesting that you would say that. Maybe, because we know there's going to be a market reset. We don't know when it's going to be or how big it's going to be. Maybe it's not a bad idea just to take your winnings, as it were, your growth.
And it's hard. It's hard for people to do. Patience is a virtue, as they say, but, it's hard for people to sit there in cash because they feel like I got to do something.
Yeah, exactly. No, you've nailed it. That's exactly my psychology. It's like, I bought NVIDIA, for example, at 8, now it's at 300, and gosh, if it goes down to 290, I don't want to lose that what I gained at 300, so I want to hang on to it, and that's a bad psychology. Warren Buffett actually said, as you've quoted before, said, don't complain about earnings you've made.
Right.
I never gripe about making money, even if it's just a little bit. Right.
Well, even some of the publications you look at, they talk about taking free rides. So what's a free ride? If you put your money into a position and it doubles, well, then you take your money back out. Whatever you paid for it, take your money back out. Now the money that's in there, basically house winnings, No.
See, I can't abide by that personally.
Well, because you've really had a lot of winnings in your particular stock.
I've been lucky. Like I said, I've been lucky. Coca-Cola did well, Visa did well for a long time, NVIDIA did well, Microsoft did well, and I have a lot of little ones. I got rid of some stuff like Sanofi. And I'm not telling. This is not stock advice, folks. I'm just venting. Really, on what
I
I've
guess
done.
The stock advice is, and again, it depends on your position in life. Like I said, if you're in a 401k and you're 30 years old, I wouldn't sweat it. You should try to max out as much as you can. You're putting as much into the plan. You're dollar cost averaging. That's all well and good. But if you're 60 or 65 years old and you've accumulated the nest egg, and you're looking at your situation and saying, hey, can I afford a 50% drop? The answer is probably no.
Not just no, hell no. No. That's what I'm looking at right now. No. I don't have another 30 years to do this.
Exactly.
I do, but, theoretically I do. I look at I look at the longevity of my father, my grandfather, my mom. I'm thinking, I don't know if I got 30 more years, but,
Right.
Yeah. So the answer there is no. But then I'm so used to investing for growth, and I want to say something else here and get your thoughts on this. So there are advisors out there saying, "Oh, what you need to do is diversify now. You keep some in the stock market, keep some in international bonds, some in municipal bonds, and that way it balances it out." And I'm thinking, wait a second, that seems to me, and maybe I'm wrong, but it seems to me. Like that's a plan for net zero growth. You're going to lose money over here, but you'll gain money over here, and then you'll lose money over there. Am I seeing this wrong as far as?
No, you're not. And actually, what you just said is that's the paradigm today. Is bonds are not the safe haven because bonds, like I said, have been in a bull market for 40 years. Think back 40 years ago, interest rates were 12-13%.
Mm-hmm.
Now they're zero. So as rates come down, as yields come down, the value of the bonds go up. It's kind of an inverse relationship. Well, now where are rates? Rates today, you buy a bond today, what are you getting on it? 1%, 2%, 10-year Treasury, at 1.6 or something. Rates are going to go up. So if rates go up, the value of the bonds are going to go down. So investors today are really between a rock and a hard place because the market is more overvalued than we've ever seen it, except for the dot-com bubble. We know there's a correction coming, and yet the safe haven isn't there as well. So
during after the Great Recession, 2008, right around in there, my mom had municipal bonds, tax-free municipal bonds. She was in California, and they became pretty much valueless. And so she had some income from them, but she lost the principal, really, of that. Had some other bonds that also became valueless as well. And then the municipality would issue new bonds. Well, who wants anything with the old bonds? No one wants to buy those old bonds because the new ones are paying a better rate. And they're structured in such a way that they don't lose value like the old ones lost value, at least not right away. They could always lose value in the future. So that's a complication.
Yeah, and then the other thing you see is, you have the people that come in and say, well, I own these stocks, but I own them for the dividends. And that's all well and good because the value of the stock could go down as long as they don't cut the dividend. Now, are dividends guaranteed? Well, the answer is no, they're not. We've seen, back in the Great Recession, you had some blue chip stocks, your Bank of Americas, your GEs, and, back then they were the bulwarks, but guess what? They cut their dividends. So not only is the value of the position going down, but then they're cutting the income from the position as well. So, yeah, it's a difficult environment right now, and again, I just tell people, look at where you're at in life and plan accordingly. I mean, if you can't afford to lose money, you got to reposition.
And how long you going to live? I mean, my dad 90, my granddad is 80s, my mom about 80. So you take a look at that, and how old are you right now?
The other thing to consider is when you get into your 60s and 70s, it really shouldn't be about growth at that point. It's really about income. Mm-hmm. So it's that pivotal period where, hey, let's transform your retirement portfolio. Instead of positioning it for growth, you really need to position it for income, because at the end of the day, when you're retired, it's just, hey, how much do I have to spend every month?
So the other thing I have to think about, though, and everybody listening, you have to think about as well, is, well, how long are you going to think you're going to live? Like I said, my granddad was in his 80s. I'm not exactly sure how old. I think it was like about 87, 88. Dad was 90. Mom was 80. But that's because she wouldldn't take warfarin. There's a lot of personal information I'm sharing right now. I hope they don't mind.
It's probably against the laws,
Yeah, no. So you wonder, you're going to need growth. I mean, especially if you want to leave something for the kids, you don't want to just spend it all, although that's usually what happens. But I understand that that they have new life expectancy tables in effect now as well. What are those looking like? What's that looking like?
Yeah, what happened? This came out during the Secure Act. Back in 2019, when they come out with it, we're going to come out with a new life expectancy table. Supposed to be out in 20, supposed to be out in 21. Didn't happen in either of those years, but now in 2022, they do have it out. And as you remember from the Secure Act, they also raised the RMD age from 70.5 to 72. Mm-hmm. So, and in effect, all they did, I'm looking at the table right now, they took the 70.5 numbers. The factor at 70.5 was 27.4. Now that's the new factor at 72. So all they did, they kind of took the old table from 70.5 and they just said, all right, now you don't have to take anything until 72, and we're going to start with the same table at 72. So it's good news because, again, it was about 3.6% when you hit 70.5, and now you don't have to take anything out till 72, and it's going to be about 3.6% then as well.
Although if inflation hits, you go to cash, you're going to have to take more out. Sorry.
That's true.
I try to be optimistic, but it's tough. All right, so the blog you'll find at danwhiteandassociates.com. That's your website, danwhiteandassociates.com. That's the blog. And you get to hear the podcast of your Sunday program at WDEL.com. It's the Dan White podcast. And what's on this Sunday at 7 o'clock in the morning?
Yeah, this Sunday kind of dovetails in nicely with what we've just been talking about, Rick. And last week I talked about the Federal Reserve and how they kind of created inflation with some of the moves that they've made. And now this week's topic is, hey, the Fed is kind of out of bullets. They've painted themselves into this corner, and 2022 might be the year where the market has a correction. So
it might be. And then the other analysts are saying, well, it might not be. So
yeah, nobody knows for sure. But, I mean, you look at they're kind of out of moves. I mean, they either let inflation run rampant and they don't raise rates, and then if inflation gets out of control, we go into a recession.
Right.
Or they say, hey, we're really going to come down hard on inflation and we're going to really raise rates, and if you raise rates, we usually go into a recession. So either way,
buy gold.
Either way, we're looking at buy gold.
Yeah, buy gold. Yeah, I know. I hear that all the time. Way too often. All right, Dan, always a great source of honest information. On the Money, you'll hear it Sunday mornings at 7 o'clock, and you can read his blog at danwhiteandassociates.com. Thanks, Dan. I always appreciate it, sir.
Have a great day, Rick.
All right, you too, buddy. You can give him a call at 888-690-8820 if you want to talk to him, 888-690-8820.